Gives me great pleasure always to bring on board Nilesh Shah of Envision to talk about markets, stock picking, the idea of value in this kind of a market, and where is margin of safety in this market where everybody suddenly is now excited, curious, and are ready to commit to capital. We've had a good rally in 2023. We're calling it the summer rally of 2023. Will this rally extend into the second half? If yes, what are the factors which are at play? Nilesh, always a pleasure to interact with you. Thank you for joining us. We haven't done this show in a while actually. This is one show with you especially. I always look forward to learning and understanding.
Absolutely, Nikunj. Always a pleasure to be here in your studio with you on ET Now. It's always a pleasure.
Thank you very much. So Nilesh, let's understand the market setup. Now I can look at the market on a YTD basis and say, okay, nothing, 5-6% here or there. But if I look at the market from the April low, it's more than satisfactory for index, more than satisfactory for individual stocks, and great when it comes to small cap stocks. What is the right prism to look at the market?
No, I think that's a great way to put things in perspective. And I think what has really happened, Nikunj, are two things. One is on the earnings side, by and large, most companies have positively surprised. Let's look at the backdrop. CY22. It was all about cost pressures, inflation. Will the consumers buy enough? Will the producers be able to pass on the elevated costs? And you come into 23 and just look at the kind of earnings which most companies have reported, the kind of margin improvement which most companies have reported, and the kind of economic growth that we have been able to sustain as an economy. So I think that's really the starting point where I think the earnings have been ahead of expectations, especially for smaller companies. People thought with the pressures of 22, small companies will get crushed. But that honestly didn't happen. We've seen that with a lot of our portfolio companies where actually the small guys are growing better and are turning even more capital efficient. The second thing is liquidity. I think the time retail investors or domestic investors sense that interest rates have peaked, and that at best what you could get in bank fixed deposits is the 6-7% on a pre-tax basis. I think they clearly sense that it's time to kind of be back into the SIPs, back into mutual funds or buying stocks directly. So I think it's a combination of both these factors, which I think has surprised all. And that has resulted into the markets having a pretty strong run from the lows of March or April.
Okay. We'll put out the graphic of the market from April, and this market first managed to climb the wall of worry. Then came the earnings push, then came the liquidity trigger, and now the reverse trend has started, which is QIPs have started, block deals have started, IPOs have started. So typically when markets, they see influx of IPOs, block deals, promoters selling out, it has always coincided with a near-term peak or a pause. So while the long-term picture, nobody's arguing. In the near term, do you think this market now could be hitting into a pause or a range-bound phase?
Quite possible. After this kind of a rise that we have seen, it's pretty much, I think, relatively or reasonably obvious to assume that we could hit a wall soon, given the kind of run-up that we've had. And I think that would, as we all say, that would probably be a healthy correction, a nice shakeout. I think in addition to the kind of rally that we have seen and the kind of up move and the uptick that we have seen in terms of valuations, there are three other headwinds which are emerging. One is crude oil is also kind of up quite significantly from the lows that we saw in the earlier part of the year. And we know that crude has remained our biggest challenge for now, years or for decades. And when crude goes up, that does have an impact on earnings, it does have an impact on growth, and it does have an impact in terms of the stock prices. So I think crude is one big challenge. The two is basically, will that lead to a further spike in cost of commodities? And again, therefore, does that bring back to the table the possibility of margin pressures again? Because we've had great margins for the last 1 or 2 quarters. So that, and third is cost of capital. I mean, again, the US Fed probably, I think what I read is that they're planning, saying is that probably they're not done with. And if there are further rate increases, our own Reserve Bank of India has increased the CRR. I think that's an indication that maybe a rate cut is not round the corner soon. So I think these are the three I would say, headwinds or challenges, which could also lead to we hitting the wall much sooner. In addition to, of course, supply of paper, supply of securities coming in from all these QIPs and all of that. So I think on the whole, we probably for now, at least in terms of the very short term or the very near term, I think there's a high chance we can get into a pause mode.
Today we are not talking about it, but a year from now or maybe 10 months from now, everybody will talk about it. The importance of central election, which would be preceded by 2 state elections. Nobody's talking politics, but that will occupy center stage. As a portfolio manager, what will you do? It could be a binary event. So how do you do risk management in the run-up to the election?
Nikunj, honestly, that's a very tough one. And I have seen many of these elections play out, and in several of the cases, the election outcome has been pretty opposite to what we could have imagined. I mean, I go back to 2004 and
yes.
Similarly 2009. These were really honestly
circuit down, circuit up.
Circuit down, circuit up. So one has seen all this, and honestly, as long-term investor or as a portfolio manager, it's very, very difficult to honestly try and anticipate or second guess how the elections will go.
So for our viewers who are watching this, Nilesh, this question keeps on popping up now. Would you advise that stay the course? I mean, if you're a genuine long-term guy, don't worry about the near-term politics. If you are in for long haul, 3+, 5+, just stay calm. Don't waste too much of your energy in analyzing your portfolio impact in the election cycle. Is that your message?
Oh, absolutely. I think one should stay calm, stay composed, and stay disciplined. Very clearly, have your allocation strategy. Keep identifying great businesses or great managers with whom you would want to invest. And I just think stay the course. I think India is up for some really great times. I genuinely believe that our time has come. This is going to be India's decade. And there is going to be huge amount of growth opportunities. And so I think that those who have missed the party so far, I still don't think it is too late. I think be there, have a plan, and remain disciplined.
Okay. We'll talk about a sector which you track, IT. And what we've done is that since you were coming, my producer anticipated this question. And she's brilliantly looked at the 5-year averages for large cap IT stocks, just for our reference for our viewers. So Nilesh, I'll split the IT space right in the center. Bread and butter business and the AI challenge. The bread and butter business is a function of US economy. AI is something which no one knows. Analyze the big picture for us. Post-COVID, the sugar rush is over, but AI disruption is real. What is the best way of looking at IT now?
So Nikunj, the way I look at IT, and I'll probably slightly cast a more long-term perspective. I think the big boys in IT, I think they are great capital efficient companies, but they're going to be relatively moderate in terms of their growth rates.
Okay.
No matter how great the opportunity is.
The size has become large for them.
Their size has become so big that I think it's going to be hard for them to kind of grow in double digits. Even if you look at, say, an Infosys or a TCS, the last 10 years, and in last 10 years, so much of technological advancement has happened. They have grown at probably 10, at best maybe 12% in terms of the revenues and maybe 13-14% in terms of earnings. Now that's not bad. It's good, but they're not necessarily those hyper growth stocks. They're brilliant in terms of capital efficiency. They will sustain a 25% margin. They'll have 25% ROE. So that's great. So it's always great to buy them around towards the lower end of the valuation range.
Are we there yet?
I think we were there in early April when, say, a stock like Infosys went to about 21 times trailing earnings. I probably think that close to 20, 21 times is a very good floor for a stock like this or a company like this. I think you're better off just, following this principle that these are essentially, they have demonstrated the power of scale.
Yeah.
Okay. But beyond a point, scale doesn't deliver growth because the scale itself becomes your own enemy or your own challenge. And I think that's where really the big boys are in. Obviously, if you're running an index strategy, a large cap strategy, it's a good place to be. Then we went on to the power of specialization. There were a lot of companies, like say a Tata LXC,
which did very well.
Which did very well.
What
the power of
20x?
You know what, Nikunj? It's actually over 10 years been 100x.
Yeah. Wow.
if you were having this discussion in 2013 and you had two options, and why I'm bringing this up is because today Nvidia is so much celebrated.
Yes.
In 2013, if you had put your money in, and you didn't know what Nvidia was,
Yes.
at least let me be honest, I didn't know what Nvidia was, but I knew what Tata Elxsi was. Outcome in 10 years has almost been the same.
Wow.
From the bottom to the peak. And this I'm saying is when Tata Elxsi was at 10,000 rupees, 1.5 years back. Maybe
and Tata Elxsi was never the top top recall name for anybody.
Absolutely.
2000 to 2015,
Because
it never did anything great.
Yes.
It was a Tata Group company, but always disappointed.
Yes. But it ended up, so if you look at it, Tata Elxsi sometime in 2013 was actually at 100 rupees. And sometime in late 21 and 22, it went to 10,000 rupees.
What price did you look at?
We'll not get into that. I'll stay away from that. But I'm just trying to concern, but that was the power of specialization.
Yeah. Okay, fair point. It's a great point.
I think from there, we've moved on into the world of the power of products.
Okay.
Where a lot of the SaaS-oriented companies or companies which were very focused on specialized areas. You could be a SaaS provider in the travel hospitality vertical, or you could be a SaaS or a products company in banking, financial services. I think it's important to look at that part. It's great to look at, I think, some of the platform companies who are using technology to grow, or look for companies which are deep tech companies.
What is deep tech?
I think where you have developed so many strong competencies which are very hard for anybody else to create and have a very wide-ranging applications.
Which company qualifies the cut?
So currently one company that we've just recently invested in, we own it, is essentially MapMyIndia C Infosystems, which went public I think a year and a half back.
But they've had a volatile delivery record.
Not really. And that's always a challenge, that a service company can deliver to you quarter-on-quarter performance.
Yes.
But a product company may not be able to deliver you quarter-on-quarter performance.
We're not used to tracking it that way, so markets they tend to get nervous.
Correct. So you have to, I think we all have to come to reality that IT services is one thing and products, SaaS and deep tech is another thing.
But globally, Nilesh, SaaS companies have also come down. A clear example is FarmWorks, Freshworks, I beg your pardon, thank you.
Yeah.
It had a great listing. SaaS, the first Indian SaaS company to go public, and then it's down, it's struggling, it is not reporting great numbers.
Yes.
So while SaaS is a great idea, but theoretically, globally, SaaS companies are not doing well. And I've seen globally what happens normally adopts here.
The challenge with those companies is that they still don't make money. Yeah. They still have losses. Some of them have accounting losses because of high ESOP provisioning, but otherwise they don't have clear demonstrable earnings to showcase. And public markets are always about earnings and cash flows. No matter what you grow, but earnings and cash flows matter the most. Fortunately, in India, we have some of the companies in this bucket which have relatively more consistent growth. They may not have the hyper growth, but they still have growth and also have strong earnings and cash flows. And I think, I also believe that this is not just India's decade, it's India's decade. And therefore, any company which has deep tech capabilities and has a wide-ranging use cases in the Indian context, I think can be in for good times.
Any new acronyms?
Well,
you always give us one.
No, none for now. But I think so. So again, coming back to technology, I still think that there are several opportunities in the broader market. I think if you take your eyes off the top 3, 4, 5 names and look at maybe some of the other companies, I think there are interesting opportunities.
What is your basket of tech looking like then? MapMyIndia is one. I think you had LTT.
LTTS is something which we continue to own. Newgen is something that we have liked, and I think it's a very interesting company also. So I think for now, I think we have these 3, 4 such kind of companies which we believe have a very good runway of growth. But I think we keep scouting out for opportunities there.
Nilesh, we talk about banking, and the sector has just delivered parabolic earnings growth. Stocks did very well in 2022. They did reasonably well in 2023. But is banking more like a consensus trade? Everybody likes it, everybody owns it, and that's when the underperformance will start. And this year the bank Nifty did nothing, frankly, if you think about it.
So again, I probably think, Nikunj, that even in banking we could go something similar to the way we've seen in IT.
Okay, so let's do that.
That the top 3-4, like the top 3-4 IT companies, I think similarly the top 3-4 banking companies will probably grow in double digits.
Okay.
So obviously that growth rate is better versus the top IT companies, but I still think probably they'll grow at about maybe 15% plus minus 2-3%. I think versus that, we will see a lot of smaller banks or specialized lenders or maybe some of the fintechs itself who can grow at a much higher pace.
Okay.
Who could potentially grow at twice the rate of any large bank. And I think therefore still there, I think one should look out for some of the emerging names out there. Some of them have IPO'd themselves recently, some of them have IPO'd over the last 2-3 years. But that's again a very interesting space.
But Nilesh, in banking versus IT, it's always said that size matters and the right to win, the CRASA, the brand recall, cost of liabilities, always with the large guys. You look at the cost of liability of SBI and I compare that with a Chotu PSU bank. Similarly, HDFC Bank, service, network, market domination versus a small bank. While the rate of change could be different, here we are talking about customer experience, ability to withstand the shock, bet on size and market share gains. They still are moving towards large cap banks.
No, that point very well taken. But what we have seen essentially is that one is, of course, apart from all of this, what you mentioned, I think the credit cost is, I think, very important. Your ability to, price your loans well, price your risk well. I mean, to know risk well, price it well, and monitor it well, I think is the defining feature of any banking business or any lending business. I think any bank who gets that right, irrespective of the size, will be a winner.
So cost of liability is important.
Credit cost, I think to me is the most important thing, followed by cost of liabilities. And what's happening, Nikunj, I think is, unlike the past, maybe 10-20 years back, you probably had faith only in the top 2-3 names.
Yeah.
But I think thanks to an extremely good regulatory environment, the fact that we have such proactive regulators, I think they have been able to create a lot of trust and faith in the system. Look at what's happening to banks in the US versus the banks here in India. Okay, huge difference. And I think a lot of credit for that goes to our regulators who have been able to create that faith in our financial system and in our banking system.
What happened with some of the banks was an asset liability mismatch. Unheard of. That situation unheard of, at least in India.
So I think a lot of the smaller players in India have been able to either create a very good liability franchise or have been able to raise a lot of capital from private equity funds and therefore today have enough cushion to grow at least for the next 2, 3, 4 years. So I don't know what will happen maybe 5 years later or 10 years later, but at least for the next 2, 3 years, a lot of the smaller and specialized players in the banking and lending and credit space will probably do much better than the very large and the very obvious names.
You've been a happy investor in IDFC Bank. I think you bought IDFC Limited and IDFC Bank both, and now the merger goes through. The stock has gone almost 3x in last 1.5 years. Are you, as of today, do you see that becoming one of your core, will it stay one of your core holdings for next 2-3 years?
It looks like, Nikunj. I think they've done a fabulous job on execution. Look at the kind of challenges which they faced. As they say, that it's an existential crisis. And I think at least so far they have been able to convert that adversity into an opportunity where they, in this period, they essentially wrote off all the legacy loans. They built a very solid liability franchise of maybe 45 to 50% CASA.
Low NPAs.
Managed credit costs very well, especially on the retail book. Obviously, of course, the naysayers will keep saying, let the book season, we will have to see what the credit cost is and all of that. But you have to keep in mind, they've been doing this for 15 years and not the last 5 years in their earlier avatar as Capital First. So I think on the whole, it looks fantastic. I think if they continue to do what they do currently, I think they have a great chance of being an outstanding bank. The big lever which they have is the cost to income ratio. If you look at any of the big banks, the cost to income ratio is at 40 to 45%. For IDFC First Bank, it's at 70 to 75%. That's because they've been investing in branches, people, talent, technology.
Legacy also was a challenge for
all of that. If over the next 5 to 10 years, if they can basically bring down that 70-75% to 40-45% and keep growing the loan book at maybe just about 20%, that can translate into some really nice compounding earnings growth for a long period of time. And so I think they have a fantastic opportunity ahead of them. They have great levers out there. Let's hope for the best.
You know, it's been a new learning for me, Nilesh. I'm sharing with our viewers that if you look at the Indian market setup, 90% of the participants have a view which is less than 1 year. 5% of the market participants have a time frame of 1 to 3 years. And less than 2% market participants have a time frame of have more than 5 years. So I'll take the first one out because this is where you don't invest. 1, 2, 3 is where you look at turnaround stories, market share gain, inflection points. And 5-year plus is where you look at classic compounders. So let's understand in time bracket. 1, 2, 3, what qualifies the cut for you? 5 plus, what qualifies the cut for you?
I think in 1, 2, 3, it would be businesses like the Capex kind of companies, because we are at the start of an investment cycle. So a lot of these product companies will do extremely well. People who essentially are supplying equipment and components and consumables to a lot of the infra projects or to some of the manufacturing companies. I think that space will do extremely well for the next 1 to 3 years. I think there's a good chance for real estate and real estate oriented companies to essentially keep doing well. I think from a more longer term perspective, I think pockets again like specialized technology, specialized banks or specialized lenders, some of the fintech kind of businesses, discretionary consumption, especially those where a very young growing middle class is beginning to tilt its consumption basket towards. So companies which are into alcoholic beverages or consumption or some of the other luxury products, if you would call them as luxury products, I think that kind of a basket looks pretty good from a 5-year plus kind of a horizon, because these are huge markets, underserved markets. And I think if you can find a company which essentially is at the forefront and is in a vantage position to ride this long runway of growth, I think you could essentially be sitting on some great compounders.
What we'll do now, Nilesh, is that we'll look at few multibaggers, and these are absolute stunners. You know, the first multibagger, if you talk about last decade, is Bajaj Finance. That's the top recall. Last 20 years is HDFC Bank, Tata Elxsi, another multibagger. But there are some very ordinary names in last 10 years which are up 20 times, 25 times. One is Tube Investments. Never thought that a classic like Tube Investments could be a multibagger in last 10 years. Other one is Escorts. Out of the blue, Rakesh Junwala invested in it and just hit out of the park. The third one is Sundaram Finance, Sundaram Fasteners. These are old companies, Nilesh, but suddenly they've changed their gyration and the trajectory in last 10 years. Which are some stocks which may not be part of new tech, fintech, not part of the new breed of IPO, but these are companies which are at an inflection point because they've done the hard work, they've done the groundwork. So they are in the existing pool, old vintage crop, but the new season has started for them. From the vintage, from the classics.
No, I totally agree, Nikunj. And at times, we keep saying simple is boring or old is boring, but...
Which is so fascinating when I looked at Tube Investments, Escorts.
Absolutely.
Even Raymond's.
Yes, absolutely.
Whatever may be the reason, it's got done 132 to 2000 in 10 years.
Yes. My view is it would probably somebody from the manufacturing pack. I think the manufacturing pack is up for good times. A lot of reforms have happened in the last 5 to 7 years which benefit manufacturing companies. I think a lot more will be done in terms of reforms. So I think manufacturing is one great place where a lot could happen, and I think in the overall, while of course electronic manufacturing services, the EMS players and all of them are there, but the valuation, the businesses could still compound at 20, 30, 40%, but valuations are of course
what would you be looking at buying if there is a panic in the market? Look,
I think sorry?
I mean, if there's panic in the market.
No, I think if it is manufacturing and if it is in that context, I think it would be a great auto component company. I think something in auto components, I think would probably pass the muster.
Okay, whole host of stocks and market ideas coming in from none other than Nilesh Shah from Envision Capital.